The price of gold and silver has shot through the roof and there is an absolute frenzy going around in the market. Something that I've not seen in the gold market for a very long time. Given this, in this video, I thought I'll talk about should you even invest in gold and silver, and if you feel the need to invest, then what's the best way to do that? Thanks to the FOMO with gold prices, people have been doing some really stupid things and losing their hard-earned money. Last week, a friend of mine called me out of nowhere. We've not been in regular touch. We meet occasionally at weddings and parties, so I was a bit surprised to receive his call. After the initial 2 minutes of pleasantry, he got straight to the point. He had lost nearly 2 lakhs investing in gold and wanted my advice on how to recover the losses. I was a little taken aback to hear this. I mean, how could one lose money in gold when in fact gold has shot up nearly 90% in the last 1 year and nearly 20% in Jan 2026 alone? That's when he told me that he had invested in gold futures. I got super curious as to why he chose to invest or trade in gold futures while there were many other options to invest. His reason? He saw a few experts talking about gold and gold futures on a business channel, and he felt the need to invest too, as he didn't really want to miss on the gold rally. This is a classic mistake that people make. Unfortunately, this is not just his story, but rather the story of many misguided investors. Understandably so, because the demand for these metals has shot through the roof. Indians are increasingly buying coins and bars in physical market. The country's physical gold imports rose nearly 2% from a year earlier to nearly 60 billion in 2025, while silver imports jumped 44% to 9.2 billion even at such high prices. India spends nearly 1/10 of its total foreign exchange reserves on gold and silver imports. And the import bill is expected to increase even further in 2026 as the price of both these metals continue to surge. Given all the mania in gold, people are trying to participate in the gold rally in many different ways, including gold futures, just like the way my friend did. But I want you to take a step back and think through this. When you make an investment decision, the right way to think about it is from two perspectives. What is your reason for investing? And second, what is your view on pricing? Let me give you an example to illustrate this. If you choose to buy a property today, what would be your line of thinking? You will first justify your reasons to buy, be it an investment for long term or for immediate use. You will also figure the right price, maybe ask around, shop around, and then figure what could be the right price. The same holds true for gold and perhaps silver too. So let's stick to the same line of thinking and first figure reasons to buy gold. Well, there are few reasons why you should consider buying gold. Gold is a hedge against rupee depreciation. Gold is also a hedge against global uncertainty. Gold adds to your portfolio diversification. Let me quickly elaborate on all these points. First, let's talk about gold being a hedge against rupee depreciation. From single digits in the 80s to almost triple digits now, rupee has continued to depreciate. The Indian rupee devalues because we have always managed a trade deficit. In other words, India just does not export much. And occasionally, capital flees out of the country on reduced risk appetite. But the currency never seems to recover from the shock and it continues to lose its purchasing power. However, gold priced internationally in dollars automatically retains its purchasing power and hence it is a good bet against rupee depreciation. There is also a popular belief that gold is a good bet against inflation, but this is not straightforward. Yes, India has had its fair share of inflation shocks. While equities provide some shelter against inflation, it is not highly correlated. Given this, it may be tempting to turn to gold. However, there is no correlation between returns on gold and inflation in India. But the effect could be indirect. A currency shock causes inflation and results in prices of gold going up in rupee terms. The second reason to buy gold is global uncertainty. Gold's role as humanity's ultimate crisis barometer spans over 5 decades of economic turmoil and geopolitical upheaval. Gold has long periods of non-performance, but it's the first to react and shoot up when there is a global crisis. There are enough and more instances of this happening. Let me highlight a few. 1972. President Nixon served the dollar's link to gold. Gold shot up from 35 per ounce to 64. 1980 Iranian Revolution. Gold rallied 2,329%. 2008 financial crisis. Gold initially dropped 30% but eventually shot up by 120%. What we are seeing today is gold's strongest performance since the 80s. Again, this is on the back of global uncertainties, but the drivers are slightly different. The central banks, mainly from the emerging markets, are buying gold. Central banks' share of total demand rose to nearly 25 to 28%, compared with 12% of 2015 and 19. This is because emerging markets want to diversify away from dollar-heavy reserves. Not just the central banks. As of late Jan 2026, gold has breached the $5,200 mark. This is driven by the escalating Greenland crisis. The geopolitical fracture within NATO, combined with trade policy volatility and mounting US fiscal deficits, has created an ideal condition for gold's rally. But what I mean to convey here is that whenever there is global uncertainty, whatever be its drivers, gold always reacts. Finally, the third reason to buy gold is to add diversification to your portfolio. Equities only partially offset the loss of buying power due to inflation or depreciation. Given the inherent volatility of equities, it makes sense to diversify into uncorrelated assets. And gold fills this gap. There's not much correlation between the annual returns of Nifty 50 and gold returns. However, combining the two makes sense. Since the year 2000, gold has beaten Nifty 50 14.14% versus 13.21% CAGR. And this comes with a higher Sharpe ratio as well. The cumulative returns hides the fact that over any 3 or 5 year periods, you will look like a fool for having chosen one asset over the other. So in summary, buy gold if you want a hedge against rupee depreciation, you fear global crisis unfolding over the next few years or decades, and you want to diversify your portfolio. I'm guessing as investors, we all would want that. So there is definitely a case for having some gold in our portfolios. However, the question is how much gold? I once heard a financial advisor suggest up to 5% exposure to gold in a person's portfolio. I hope no one takes such advice seriously. The problem with such exposure is that it does nothing to your portfolio. Even if gold prices doubles, the material difference to an average individual's portfolio is negligible. If you consider investing in gold, my advice would be at least a 15 to 20% exposure. But wait, does that mean you go right away and buy gold? Is it really the right time to buy gold, or should you even wait for a correction? Well, this is the trickiest bit when investing in gold. Gold is only worth what buyers are willing to pay for it. Meaning there is no real way to price gold as it does not have any pricing vectors like dividend yield or cash flow. Gold price is driven by stories and narratives. So no matter what you do, you can't really arrive at a definitive price for gold. Given this, my personal recommendation is to stick to the classic SIP technique to build exposure to gold. If your target is to build a 15-20% exposure to gold, then plan accordingly and figure what should be your monthly investment. Today, unfortunately, it's no longer possible to invest in SGBs. Else that would have been my first preference. But if I were to get an exposure to gold, I would probably pick a gold ETF or gold Bs as my preferred vehicle to gain exposure to gold. I know people prefer physical gold, but I'm not a fan of physical gold, so I've personally not really spent time figuring out if bars and coins are a good way to gain exposure. Also, the fact that there are several charge leakages and the fact that storage is an issue, physical gold is not really my cup of tea. Lastly, if your idea is to gain long-term exposure to gold, then choose your vehicle of investment wisely. Don't confuse yourself to trade gold futures or options thinking that you're investing in gold. Gold futures and options are complex instruments, and it's best suited for short-term traders who want to speculate on short-term price moves. I hope you found this video useful. Do comment below and let me know what is your vehicle of investment. Is it gold ETFs, gold Bs, or physical gold? I'll see you in the next video. Happy learning.